When you study more than a century of American financial data, stretching from the 1920s to the post-pandemic era, you begin to see a pattern that repeats with surprising consistency. Economists call it the financial cycle, a long arc rhythm of rising credit, expanding leverage, asset inflation, and then an inevitable reversal. While the headlines and technologies change, the underlying mechanics remain remarkably similar. A typical U.S. financial cycle moves through several recognizable phases: expansion, peak, contraction, adjustment, reset, and the eventual emergence of a new expansion. Each turning point is shaped by the same core elements: tín dụng, đòn bẩy, and investor psychology. During the Roaring '20s, credit exploded and equity prices soared beyond fundamentals, ending in 1929. In the 1970s, the excess took the form of inflationary pressures. The dot-com boom of the late 1990s was fueled by speculative valuations detached from earnings. The housing bubble of the 2000s was built on household leverage and securitized mortgage credit. And more recently, the 2010s through early 2020s featured record low interest rates, rising corporate leverage, and unprecedented liquidity injections. One of the most important distinctions in American economic research is the difference between the business cycle, as tracked by the NBER, and the financial cycle. The business cycle tends to move in shorter waves, often 4 to 8 years, while financial cycles stretch longer and create deeper turning points. Lower rates and easy liquidity typically extend expansions by encouraging credit growth. Tightening cycles, on the other hand, tend to expose fragilities built up over years. Investor psychology adds another repeating layer to the pattern. Behavioral finance shows that herding behavior, momentum trading, fear, greed, and FOMO do not meaningfully change across generations. Whether in 1928, 1999, or 2021, investors have repeatedly driven asset prices above fundamentals in periods of excess optimism. Across every major cycle, a handful of quantitative indicators have reliably signaled when the system is overheating: an elevated CAPE ratio, historically tight credit spreads, high margin debt, declining corporate bond quality, and rising household debt service ratios. Even more telling are early warning signals such as the inversion of the yield curve, a phenomenon seen before nearly every major recession, including in the 1960s, 2000, 2006, and 2019. When we compare today's environment with past cycles, the parallels become clear. Elevated leverage, extended valuations, tightening monetary policy, and widening credit spreads. None of these guarantee an imminent turning point, but taken together, they highlight that financial cycles are not random events. They are recurring structures that leave measurable footprints. Understanding these long-term patterns is essential, because once the contours of a cycle become visible, the next phase can often be recognized early. And that recognition is what leads directly into the transition dynamics that define the next stage of the American financial cycle. In every major financial era of the United States, the most revealing moment isn't the crash itself. It's the quiet transition just before it. This is the phase when the country's largest institutions begin repositioning long before the broader public senses any danger. And historically, this shift has been one of the most reliable indicators that a cycle is turning. During this transition phase, institutional investors, pension funds, hedge funds, major banks start reducing risk exposure. They tilt portfolios toward defensive assets, raise cash allocations, and shorten duration. These changes rarely appear dramatic on the surface, but in aggregate, they reflect a deliberate move toward safety. Insider activity reinforces this pattern. Corporate executives tend to sell more aggressively when valuations reach elevated levels, a trend documented throughout peaks in 1999, 2007, and 2021. At the same time, corporations slow down their buyback programs as borrowing costs rise, signaling that cheap capital is no longer guaranteed. Credit conditions often provide the clearest confirmation that the cycle is shifting. Senior loan officer survey data begins to show tighter lending standards for both businesses and households. This tightening flows directly into the real economy. Companies face higher refinancing costs, consumers apply for fewer loans, and credit card balances grow more slowly. Meanwhile, major economic indicators start showing fatigue. GDP growth drifts below trend, corporate earnings plateau, and retail sales soften. Industrial production often surprises to the downside, suggesting that demand is weakening even before headline data fully reflects it. As funding becomes more expensive, multiple compression begins. Equity valuations contract not because companies are failing, but because the discount rate is rising. This process can unfold quietly for months, but its cumulative effect is significant. Historical yield curve inversions, such as those in 2000, 2006, and 2019, have consistently appeared during these transition phases. Each inversion raised recession probabilities, according to Fed and NBER models, reinforcing the notion that monetary tightening eventually forces a realignment. Bond markets echo these signals. Investment-grade and high-yield credit spreads widen, and liquidity in key funding markets weakens. Institutions respond by reallocating capital into T-bills and money market funds. This shift accelerates as IPOs, SPACs, and corporate debt issuance decline sharply. The cost of capital rises, and the appetite for risk diminishes across the financial system. Yet the general public rarely notices these changes in real time. Employment data, consumer sentiment reports, and GDP revisions all lag the real economy. Retail investors, typically relying on backward-looking metrics, continue buying well into the peak, unaware that institutions have already adjusted their exposure. This entire pattern resembles past transition phases. The build-up before the dot-com unwind in 1999, the tightening cycle before the housing collapse in 2007, the liquidity contraction in 2018, and the rapid rate hikes of 2022. Across all these periods, the United States displayed the same rhythm. Institutional repositioning first, public recognition later, and systemic stress soon after. Understanding this phase is crucial because it sets the foundation for everything that comes next. When a financial cycle moves beyond its initial transition phase and into visible strain, the first fractures rarely appear randomly. They emerge in the same fault lines that have historically defined American downturns. Banking, commercial real estate, consumer credit, and high-growth technology tend to react first when credit conditions tighten. These sectors share a common vulnerability: long-dated assets financed by short-term borrowing. It's the same imbalance that stressed savings and loan institutions in the 1980s, mortgage lenders in 2008, and several regional banks in 2023. As interest rates rise, leverage becomes heavier. Companies with high debt loads face refinancing pressure, often months before the public recognizes the stress. Debt rollover risk is one of the most dependable indicators of an approaching contraction. When borrowing costs climb and capital markets dry up, firms that rely on frequent refinancing hit a wall quickly, especially in commercial real estate and high-yield credit. Higher rates also weaken the borrower base. Households feel the squeeze through rising credit card interest, auto loan payments, and mortgage resets. Corporations face the same tightening. Servicing costs rise while asset values fall. When collateral, whether commercial buildings, equipment, or equities, declines in value, the banking system absorbs the impact. Historically, these dynamics show up first in widening credit spreads and rising default rates. Data from multiple cycles reveal a consistent pattern. Defaults surge 12 to 18 months after the Federal Reserve begins tightening. Regional banks, which form the backbone of U.S. small business lending, react predictably in periods of strain. They reduce new loans, strengthen underwriting standards, and increase loan loss provisions. These defensive moves ripple outward. When banks tighten, commercial real estate borrowers struggle to refinance properties. Vacancy rates rise, cap rates adjust upward, and the refinancing window narrows, mirroring the pressures seen in the early 1990s commercial property downturn, and again after 2020. Stress never remains isolated. Once banking tightens, corporate credit weakens next. High-yield issuers face refinancing cliffs. And then household credit begins to show rising delinquencies. This progression is the contagion effect. Pressure moves through the system along channels of credit interdependence, amplifying itself with each step. Hedge funds also shape the character of this phase. Those using heavy leverage may be forced to liquidate assets rapidly during volatile periods, contributing to accelerated sell-offs. Others step in to exploit arbitrage opportunities, creating sharp, short-lived swings in pricing. This dynamic was visible during the long-term capital management collapse in 1998, the quant crisis of 2007, and several dislocations in March 2020. History provides a library of sectoral collapses that serve as reference points. The S&L crisis of the 1980s, the dot-com unwind of 2000, the housing crash of 2008, and the energy sector collapse in 2020. Each period revealed the same pattern. Stress concentrates where leverage is highest and liquidity thinnest. Once systemic indicators breach historical thresholds, policymakers begin taking notice. Rising defaults, widening credit spreads, and liquidity stress signal that the system is approaching a point where the Federal Reserve and the U.S. Treasury must weigh stabilization tools. At this stage, the groundwork is being laid for the policy-driven descent that follows, where the government attempts to contain the fallout before the cycle enters its ultimate repricing phase. When a financial cycle begins to descend, the slowdown rarely arrives with dramatic headlines. More often, it starts quietly, through shifts inside America's credit system. Lending becomes more restrictive for both households and businesses. Liquidity across key markets begins to contract. Investors move steadily out of risk assets and into safer holdings, marking the early signs of a tightening environment that historically precedes deeper market adjustments. Inside the Federal Reserve, policymakers track a familiar suite of stress indicators: repo rates, funding market pressures, OIS spreads, and widening gaps between corporate and Treasury yields. These metrics help the Fed judge not only the level of stress, but also how quickly it may transmit across the financial system. During past cycles, especially in 2008 and again in 2020, early recognition of these signals shaped the speed and scale of intervention. Once the decline accelerates, the Fed activates its stabilization toolkit. Rate cuts aim to reduce borrowing costs. Asset purchases help restore liquidity when credit markets seize. Emergency lending facilities, modeled after programs used during historical crises, offer temporary support to institutions facing acute funding challenges. Each response is calibrated to prevent stress from spreading into a systemic freeze. At the same time, the U.S. Treasury steps into a coordinating role, leveraging the Exchange Stabilization Fund and other tools to reinforce capital markets. These interventions are designed not to boost asset prices, but to preserve the functionality of essential financial channels. In periods like the early 1990s, 2008, and 2020, this coordination between monetary and fiscal authorities proved decisive in preventing further deterioration. Policy uncertainty itself becomes a powerful market force. When investors cannot anticipate the timing or scale of intervention, volatility spikes. Asset valuations adjust suddenly based on shifting expectations, making the descent phase one of the most unpredictable segments of any cycle. Corporate bankruptcies rise in line with historical patterns, particularly among small and mid-sized firms. Cyclical sectors, retail, energy, commercial real estate, tend to feel the impact first. In response, capital flows migrate toward cash, gold, and short-term treasuries, echoing behaviors observed in episodes from the 1970s through the post-COVID tightening cycle. Throughout this stage, retail investors typically react slower than institutions, relying on lagging indicators that mask the underlying deterioration. By the time broader sentiment shifts, markets have often already repriced significantly. Historically, this phase lasts 6 to 18 months, depending on system-wide leverage and policy response speed. The descent ends not when markets rebound, but when stress stops intensifying. Liquidity begins to stabilize, credit markets reopen, and policymakers prepare the groundwork for the repricing phase that sets the foundation for the next cycle. When an economy reaches the bottom of a financial cycle, the shift is rarely announced with a single dramatic moment. Instead, it emerges through a pattern economists have seen repeat across U.S. history. From the banking reforms of the 1930s to the post-Volcker reset in the 1980s, the aftermath of the 2008 crisis, and the recovery following the pandemic shock. The reset begins quietly, with the first sign being the stabilization of credit. Lending standards stop tightening, funding markets function without disruption, and liquidity no longer drains from the system. Bond yields and credit spreads, which previously reflected rising fear, begin to flatten. This stabilization marks a turning point, not optimism, but the end of freefall. As credit steadies, valuations across markets move into historically low ranges. Price-to-earnings ratios fall back toward levels observed at the bottoms of 1982 and 2009, while the CAPE ratio resets after periods of excess. Asset prices reconnect with economic fundamentals rather than momentum or speculative flows. It's a repricing across asset classes, equities, corporate bonds, and even real estate, reflecting a broad reevaluation of risk. Companies unable to adapt are forced into restructuring or exit the market entirely, reducing the excesses accumulated during the prior expansion. Certain sectors consistently emerge first when stability returns. Core technology, energy, and financials have often led early recoveries in modern U.S. cycles, benefiting from renewed liquidity and improving expectations. As market conditions normalize, the Federal Reserve becomes a central actor. It halts quantitative tightening, initiates a rate-cutting sequence, and deploys liquidity programs depending on the severity of stress. Monetary policy shifts from restraint to support, shaping the beginning of a new market environment. Institutional investors respond quickly. Pension funds, endowments, and asset managers begin accumulating assets discounted by the previous downturn. High-quality corporate bonds become attractive as yields peak. Private equity firms identify distressed opportunities or engage in mergers and acquisitions at favorable valuations. Their early movement often precedes broader market confidence. At the same time, sentiment indicators show extreme pessimism. Retail investors withdraw. Volatility remains elevated even as markets stabilize, and surveys reflect historic lows in confidence. Ironically, history shows this environment often produces the strongest returns. In nearly every major U.S. recovery, 1933 to 1936, 1982 to 1985, 2009 to 2011, the first 12 to 36 months after the reset generated outsized gains for investors willing to re-enter early. As recovery takes shape, the structure of the U.S. economy evolves. Sectors that dominated prior expansions fade, while new leaders emerge. Technology after 2000, energy and fintech after 2008, digital infrastructure after 2020. The IPO and credit markets, frozen during the descent, gradually reopen. Access to capital improves, enabling innovation and growth. This reset phase forms the foundation of the next cycle. But it also exposes common errors. Assuming markets must fall further, confusing low prices with genuine value, or ignoring early improvements in liquidity and credit. Understanding the reset is essential, because it marks not the end of crisis, but the beginning of renewal. In the aftermath of a major financial reset, the United States often enters a period of renewed growth that feels both familiar and entirely new. As someone who has studied more than a century of American economic cycles, from the early industrial booms to the modern digital age, this phase consistently reveals the same structural heartbeat. Stabilization first, acceleration second, and euphoria last. It begins quietly, well before the public realizes the tide has turned. GDP growth settles into a steady upward trajectory as the economy digests the disruptions of the previous downturn. Corporate earnings recover, not through explosive speculation, but through lower capital costs and healthier balance sheets shaped during the contraction. With unemployment falling and wages rising, household spending strengthens, a crucial driver in a consumer-powered economy like the United States. Innovation regains momentum. Every major U.S. expansion has been anchored by a new technological engine, and today's equivalent lies in artificial intelligence, automation, biotechnology, and renewable energy. After capital expenditures pause during the stress phase, investment returns with force. This pattern echoes earlier eras: the IT surge of the 1980s, the internet wave of the late 1990s, and the post-2009 digital acceleration. Corporations, leaner after restructuring debt, begin operating with greater efficiency. Productivity increases, profit margins widen, and firms become more competitive globally. As risks recede, capital flows shift again. Institutional money moves back into equities and long-term bonds, while ETFs tied to leading sectors absorb billions in new inflows. Money market funds, once a safe harbor, see assets rotate back toward growth. Credit conditions finally ease. Banks become more willing to lend. Corporate bond issuance rises, and the foundations of a new credit cycle take shape. With easier financing and clearer forward guidance, companies start expanding, hiring more workers, increasing wages, and reopening investment pipelines. Labor force participation ticks higher as workers re-enter the job market in growing industries. Market dynamism returns. IPO activity revives, merger waves pick up, and corporate America pushes outward into new technologies and new markets. Yet beneath the optimism, early signs of overheating begin to flicker. Inflation risks resurface if growth accelerates too quickly. Asset valuations stretch beyond long-term averages, while margin debt climbs, reflecting a psychological shift from caution to speculation. Beyond economics, geopolitics adds a layer of uncertainty. Competition between the United States and China intensifies across supply chains, semiconductors, and energy technologies. Regional conflicts threaten commodity markets, and shifts in global currency structures influence dollar demand. Even so, the expansion phase is not a conclusion. It is the launchpad for the next cycle. As leverage builds and optimism turns excessive, the seeds of the next transition are planted, just as they were in the booms of the 1920s, the 1960s, the 1990s, and the 2010s. Understanding this progression allows us to recognize not just where the economy stands today, but where it inevitably moves tomorrow.